So one of the first things that you can learn from the intelligent investor is this idea that Graham calls Mr. Market. And Mr. Market in the intelligent investor is nothing more than an individual who will come to your office every day and offers you a different price to buy and sell items at. And specifically here, we are talking about shares of stock. And sometimes those prices make sense, and sometimes those prices do not make sense, either in the too high or too low way. And his whole idea is that individual investors literally do have the market, have Mr. Market offering them some price for the shares that they own, or some price at which they can purchase new shares every single day. And sometimes those prices make sense, and sometimes those prices do not make sense. And his whole point is that we don't need to just be hanging on to every little thing that Mr. Market tells us. We need to be doing our own valuation. We need to be making sure that we understand what the true economic value of a company and of a share of stock is. That way, if Mr. Market is offering a price, we know whether that particular price is reasonable or not, and we can make decisions based on the real value of a company and the real value of the stock of that particular company. Because his whole point is that investors are neither right or wrong, given that the public may agree with them in a day or 2 days or months or years. An investor is only right if the analysis bears out that the investor is right. You're not just right because you're agreed with, you are right because of the analysis that you've done and because of the ultimate outcome of a particular firm's stock. Basically, this was facts with no feelings before there was facts with no feelings. And so he talks about that. Mr. Market is a big tenet of the intelligent investor. And then he moves on to value investing. And I talked a bit about value investing a moment ago, but value investing is deriving the intrinsic value of a common stock. And the intrinsic value is this particular price at which you can put on a share of stock based on the fundamentals of the firm, based on the firm's financials and the analysis that you do on the firm's financials. Now, this is done by analyzing a company's assets, earnings, dividends, and all of the like, and using different valuation techniques. And to literally be value investing, you're trying to determine that intrinsic value, and you want that intrinsic value to be greater than the current market price at which something is selling. Therefore, you can purchase at the current market price and you can have an appreciation of price, hopefully to or above the intrinsic value. And obviously, the intrinsic value is not some price at which a firm's stock is going to settle, because stock prices move day to day because there is Mr. Market out there. But Graham wanted us to understand that if you can place an intrinsic value on a share of stock, then you are less likely to be listening to Mr. Market, and you're less likely to be swayed by his daily offerings to you. And along with this idea of intrinsic value and value investing, then Graham also talks about the idea of the margin of safety, which I brought up earlier. And this is important because the margin of safety is directly related to the intrinsic value. Now, Graham talks about having a margin of safety that is enough to keep you safe from potential losses that you may take when purchasing a particular stock. And what he means by this margin of safety is when you calculate an intrinsic value, like I just said, you want that intrinsic value to be greater than the current market price at which you would buy. But the difference in those two values, the difference in the intrinsic value and the current market price, is the margin of safety. And Graham wanted you to have enough distance between those two values that even if the intrinsic value that you calculated is not perfect and the intrinsic value that you calculated is not realized in the market, that you can still get close enough to it to have an adequate gain on that particular share of stock that you purchased. And obviously what this means is that the fluctuations of the stock market going up and down, and Mr. Market offering some prices that don't make sense, may actually create a margin of safety for you. So, for instance, if Mr. Market brings a price for a share of stock that is far below what it is actually worth, then Mr. Market has created that margin of safety, because obviously a firm is worth some value at any given point in time. And what the market is trying to do is the market is trying to determine what that value is. And sometimes the market comes up, like I said earlier, with a price that makes sense. And sometimes they come up with a price that doesn't make sense, whether that price is above what it's actually worth or below what it's actually worth. And in doing so, If the price is below what it is actually worth, then it is creating that margin of safety by the amount that that particular price is below the intrinsic value of the stock itself.